Earlier this month, the Bank of Japan raised its key interest rate for the first time in 17 years. The governor of the BOJ ended an 8-year period where the country ran negative interest rates, signalling an end to this extraordinary monetary easing scheme. Following an acceleration in inflation in the early part of this year, the central bank also abolished its yield curve control policy. These are clearly significant steps within Japan. However, the short to medium-term trajectory of inflation, economic activity, and therefore monetary policy still remains highly uncertain, especially as the country continues to grapple with a highly burdensome and deflationary demographic profile, which is seeing the country's working age population shrink at a far faster rate than most other developed nations. However, in our view, one significant trend that has become entrenched within Japan is the impact that a series of corporate governance reforms have had in both decision-making within Japanese boardrooms and in investor flows. In today's episode, we'll explore these trends in more detail and look at some of the investment opportunities presenting themselves as capital allocation decisions are changing and corporate deal flow is increasing in Japan. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. Today we're joined by Paul Ffolkes Davis, the chairman of Rising Sun Management. Paul has over 40 years experience within the financial services industry in a career which has included running the equity capital markets divisions of several investment institutions. Paul has also held various board appointments, including at NM Rothschild & Sons, in addition to being the bursar of Trinity Hall, one of Cambridge University's oldest colleges, between 2004 and 2020, in a position where he was responsible for managing investments of the college's endowment. Rising Sun is the investment advisor of the London-listed Nippon Active Value Fund, or NAVF. The Rising Sun business is led by James B. Rosenwald III and Gifford Coombs, who together co-founded Dalton Investments back in 1999 and remains CIO and portfolio manager of the business respectively. Nippon Active Value is a highly differentiated activist investment strategy investing predominantly in small and mid-cap Japanese companies. Corporate governance reform and key regulatory changes within Japan have created an environment for increased shareholder activism. For example, the introduction and subsequent gradual evolution of both the Japanese stewardship and corporate governance codes has placed ever greater obligations on both institutional investors on issues such as shareholder voting and engagement, and crucially on businesses themselves to justify or remedy long-held issues surrounding cross-shareholdings, independence of boards, and to address persistent low return on equity. In recent years, these reforms have clearly started to gain traction, evidenced through dividend payout ratios trending higher, increased corporate activity, and a number of institutional investors deploying capital to the market. Paul, hello. Thank you for joining us. How are you doing today?
Well, I'm doing surprisingly well since I'm able to speak to you from the sunny Caribbean.
From St. Kitts, good stuff. Yeah, so the first question we've been asking, just as a kind of standard kind of opener to these discussions, is one which tries to kind of a bit to know you and kind of your kind of typical working week and kind of what you've been looking at really. So I wondered are there any kind of anecdotes that you might be able to share from whether it's a company meeting or just even something that you've been reading? We've had kind of book recommendations or article recommendations from this question. Is there anything that you'd share just to kind of kick things off?
Yeah, sure. Well, my typical working week is not typical. I live in about 3 different places, so the one thing that seems to be common to all of them is computers and Zoom meetings and these sorts of discussions. But I've just come here from Italy, where I spent a lot of time as well, which is also very nice. So I'm a very lucky fellow. At the end of this month, from about the 23rd for a week, most of the principals of Rising Sun Management, which I'm chairman, the advisor to Nippon Active Value Fund, are meeting in Cayman, or Grand Cayman. This is an annual event where we have the company's AGM, and those for the Dalton Inc. companies. And I'll talk a little bit later about Dalton and its principals, Jamie Rosenwald and Clifford Combs, who are also partners of Rising Sun, because that will explain a bit of the background to Nippon Active Value Fund. So we will be all on Cayman for a week, and that is a very useful annual shindig. Lots of eating and drinking, but more importantly, we get to see people that we don't always see. A lot of the people in the back rooms, if you like, of the Dalton organization. And this year we've actually got Masumi Nishida, who is RSM's senior analyst based in Tokyo, and he's coming all the way out to join us as well. If you want a good tip for reading, there's an interesting article in today's FT, today being the 7th of March, by Leo Lewis, talking about how small Japanese companies are now becoming not just an annoyance, but an impinging effect on the efficient tidying up of the Japanese markets, which is, of course, one of the things that we are also trying to affect through our fund.
Yeah, no, good article. Yeah, no, definitely worth a read. You know, thank you for flagging that. So I think that maybe if we kind of delve into the Nippon Active Value strategy, maybe useful to start that conversation just to understand the background of why it was launched, really, this kind of prevalence of lowly valued, often cash rich, inefficiently managed businesses within Japan, but also the backdrop of recent government reforms. I wondered if you could just describe, or kind of give a summary of that backdrop and the opportunity, just to kind of provide a kind of backdrop to the picture.
Yeah, well, so let me do the quick history, because it all dovetails together. So I mentioned a moment ago Jamie Rosenwald III, who is the CIO of Rising Sun Management and also of Dalton Inc. Jamie learnt all about Japanese investing from his grandfather, Jamie Rosenwald I. And Jamie Rosenwald I was the very first non-Japanese employee of Nikko Securities, and the man who took John Templeton round the Far East for the first time in the late 60s and early 70s. He was also the guy who figured out that Japanese insurance companies traded on about half the value of US insurers, and yet in most other cases the metrics were very similar. So he and his clients made a lot of money out of Japanese insurance companies, and Jamie got the bug sitting on his grandfather's knee, if you like. So I think 27 or 28 years ago now, Jamie set up with Clifford Combs and two other partners, Dalton Investments. It's got about $3 billion under management, of which about $2 billion are invested in the Japanese market. And what they had always done, and what their investment thesis was, and still is to a lesser extent, was to invest in companies that were run by owner-operators or entrepreneur-operators, where Jamie and his colleagues could feel happy that management shared an economic alignment, if you like, with those of shareholders, and they could have friendly discussions about ways of making companies more efficient, but basically everything would be on a convivial and a basis whereby there wasn't a need to be terribly aggressive or hostile. And they've run that investment strategy for almost 30 years. What became increasingly obvious during that time was that they were investing in about 15% of the market. The other 85% of the market are what are known as salarymen-run companies. These are companies where management doesn't have an economic interest in the company. Quite often they don't own any shares at all, and if they do, it isn't very many. They are hoarding cash or cross-shareholdings or property or other form of non-operational assets on the balance sheet so that they can sleep quietly at night. And although the companies may be very good, they tend to be, in our case anyway, small manufacturing companies, or they may be indifferent. There is a lot to say that these companies, though, can be improved in the way in which they allocate capital. And the reason why Jamie suddenly became interested in these companies was because in 2014, Prime Minister Abe began the corporate governance reform program, which you hear so much about, and which he and successive governments have been adding to year after year. And this is provided at the beginning. We set our fund up in February 2020. This provided, if you like, a reason to start an activist fund that would chase smaller Japanese companies. Small Japanese companies, almost by definition, because we were only able to raise £100 million when we began, just before COVID. So we didn't have that much ammunition, and those were the companies that we thought we could have the greatest impact on for obvious reasons. And we were trying to add to the volume of activist activity in Japan, both foreign and domestic, that was trying to lever these various corporate governance reforms. Corporate governance reforms are not kind of an altruistic enterprise by Mr. Abe's government. You need to remember that the combination of the finance ministry and the Japanese state pension company own about 12 to 13% of the entire stock exchange. So the largest investor in Japan is Japan Inc. And more recently, Mr. Yamaji, who is in charge of the stock exchanges, has been adding to the fuel, if you like, pushing these companies along. What was a wind at our back is becoming a gale, by trying to get companies to explain what they're going to do if they're trading well below book value, what their corporate plans are to generally increase the efficiency of their capital allocation, the diversity of their boards, the percentage of stock that they may hold through restricted stock programs, etc. So the process that began in 2014 continues. It's now becoming really very hard for Japanese companies of all sizes to ignore it. And during the course of the 4 years that we've been operating, we've gone from £100 million to currently today 328 million. And the NAV's gone from 100 when we began to about 175. So we've done pretty well. We were able to increase the size of the fund by absorbing 2 other failing investment trusts last summer. So we are regarded as pioneers in the consolidation of the investment trust industry, not something we'd expected to be, but both these funds were quite different from us. One was a large cap long-only fund, the other was a small cap long-only fund. But very enterprising boards in both cases felt that they had to offer their shareholders interesting choices rather than just say we're going to wind the fund up because we expect to lose a continuation vote. And in both cases, the board and the shareholders elected to combine with the Nippon Active Value Fund. So that gave us a real step up, and we have now a lot more firepower and are able to be heard earlier in the process than perhaps we were before. When we appear on a share register now, companies take note. That's not just because we've had some successes, but it is also because of the corporate governance reform program. So for us, the whole thing was very fortuitous timing and has worked very well.
Yeah. That's really helpful to kind of lay the ground. Yeah, certainly an opportunity set there with the companies, and often very lowly valued and inefficient, but also the kind of tailwind of corporate reform. And I mean, you kind of mentioned throughout that kind of this activist approach, or the kind of pursuit of value enhancing strategies, and I guess that's the kind of third piece to the tailwinds of government reform and the valuation. I mean, but engagement or activism, I mean, it does come in different forms. I mean, we've met various activist investors over the years. Are you able to kind of talk us through your kind of typical approach there?
Yeah, sure. The one thing I would say is that the biggest activist in Japan is not either us or even Mr. Murakami, who's a very famous local activist. It is, in fact, Mr. Yamaji. Without him, we'd all be struggling a bit more. So I take my hat off to him. Let's think about the kind of companies that we invest in, and that will tell you how we typically approach them. So we started off, and we haven't really changed this approach, in looking for companies that we thought were reasonable to good. They don't have to be the best companies in the sector, but we'd rather not invest in stinkers. What we're looking for are companies with an open share register. So they're not easily able to block us by poison pills or large shareholdings through friends that can control them or they can cooperate with. We are particularly attracted to companies which are not widely covered by the analyst industry, and particularly where there are no reports published in English. So, if you like, the company is an unknown quantity and easier to engage with. And obviously, we're looking for companies that are trading on a very cheap multiple. So, Yamaji-san made the point when he began his crusade at the beginning of last year that over 50% of all Japanese companies at the time were trading below book value. That will be better now, but not a hell of a lot better. So, it'll be slightly less than 50% probably. So those were the companies that we wanted to go for. We always wanted to pitch ourselves as friendly. We don't want to be terrifying. What we wanted to do, and what we started to do during COVID, was write letters saying that we were on the share register, why we liked the company and what we didn't like about the company, and in particular what we thought that companies might consider doing to improve their capital allocation. And this is not necessarily purely economic. We wanted them to award themselves shares in the company through restricted stock programs, though they would start to think a bit like us. Typically, Japanese companies have got used over the years since the bust of the late 1980s to regarding shareholders as a bit of an annoyance and as just another stakeholder. So we always made the point, and I used to write these letters 4 years ago, that we're not just stakeholders, we own the company, and that they need to think about that. And that if they own some shares themselves, that would help concentrate their minds. We also were pushing greater diversity on the board, both in terms of women, which are very, as a group, are very underrepresented in Japanese business generally, but also the use of experts. When a Japanese company put a financial person on the board, he tends to be an accountant. Well, you may have a higher opinion of accountants than I do, but they're not experts on anything other than numbers, and they never understand what the numbers mean. If you put a pound sign in front of them, it doesn't make too much difference, or a yen sign. So we said you need to appoint bankers or financiers or people who can actually give you some genuine help in understanding what you could be doing better. As COVID passed, we were able more and more to use the great advantage that we think we have over some other funds, which is the fact that Dalton has had an office in Tokyo for 20 years. and we were able to put a dedicated analyst just for RSM, or Rising Sun Management Funds, in that office. We chose as our president of Rising Sun Management a man called Kazutaka Mitsuwachi. I've already suggested that he's a sensei, which basically means teacher, but is a term that they give lawyers. And the Japanese are unusual in the modern world in that they revere lawyers and they take them very seriously. And having as your president a leading M&A lawyer means that we have access to senior management of any company when we want it. And that is a lot easier than trying to send in a junior analyst who tends to get fobbed off with the publicity or the communications department. So that is the kind of path that we trod. We had greater and lesser success with different companies. Increasingly now, what used to be a blanket no is a maybe, or let's talk. That's the big change that I think the government reforms have effected, that when we appear on a share register, companies know now they just can't ignore us. It's not the fact that we're bigger, it's the fact that you just can't ignore activist investors anymore. You need to engage with them. And some companies have done things that we wanted them to do. Others haven't and continue not to, and we continue to engage with those companies. And the more we engage, the less friendly we become.
Yeah, sure. Yeah, I was going to ask you about some of the early success stories that you've had with the strategy. There's clearly several different ways in which you could generate value through the process of engaging with company management, perhaps two obvious ones being to encourage better capital allocation, or potentially via corporate activity such as a merger or private equity acquisition. Could I ask you to perhaps run through a couple of examples where you have had notable success with engagement?
Yeah, sure. Let's talk about different effects on different companies. So we tended to go, as I said, for smaller companies. We've had a few mid-sized companies as well. Perhaps the best example of one that actually listened to us and thought what we were saying was sensible is a company called Mitsubishi Welting. It does what it says on the can. It makes rubber belts, rubber timing belts, mostly for Toyota, but it does other things. It makes conveyor belts for airports and these sorts of things. Good company, sitting on a pile of cash, running its business perfectly sensibly. We went to see them. We sat down with them in Kobe. We said, look, we like this company. We like what you do. In any other country, you would probably have been absorbed into Toyota's supply chain, but that isn't the way things work in Japan. In Japan, the large companies like to have dedicated suppliers who they think they have a great influence over, and that's probably true. But there are lots of things that we think you can do with your business while continuing to grow it, and to make yourselves more efficient. They came back to us a little while later because we'd said that we were going to write them a letter to their AGM suggesting various things that they ought to do, although we knew that they would all be voted down because that is the history of how these things work. They prefer not to be embarrassed by shareholders writing lots of different suggestions. So they came back and said, look, if we do what you're asking us to do, will you withdraw your AGM recommendations? So we said, yeah, sure we will. What have you got in mind? So the company then committed to a 100% payout of its earnings through dividends for 3 years. It did a large buyback. It instituted a restricted stock program for management, and I think it made various reforms to the board as well. So basically, they did everything that we ever asked for. When all of those things were announced, the stock moved 83% that week and has since almost tripled. And we did withdraw our demands, and we have remained good friends of theirs ever since. particularly proven by the fact that the Nikkei then wrote an article about how we were doing because we were having some successes generally. I mentioned Mitsubishi Bolting to the guy who wrote the article. He actually interviewed the company, and the company said, yes, we like these guys. We think they've been very helpful. Look at our stock price. We had all this cash on the balance sheet that we didn't need operationally. So thank you very much, Nippon Active Value Fund. We still own some Mitsubishi Bolting. We've sold quite a bit of it. We think that probably most of what we wanted to achieve there has happened. But that is an example, perhaps, of a company that chose to pull the levers that it had.
And the results and impact was clear. Yeah, no, that's a really good example.
Let's look at two other. I'll give you two other examples of companies where things have gone differently. Our biggest position for a very long time was a company called Intage Holdings, which is Japan's largest market research company. We felt that it was a very, very good company, and it's very well run, and the CEO is an interesting guy. But we didn't think it needed to be public. But he was absolutely insistent that his clients took a great deal of credibility from the fact that the company was public and wasn't going to engage with the nasty foreign aggressors. And we got to the point of actually writing letters and publishing them saying that we thought that they ought to do an MBO at a particular price. And this went on actually for about 3 years. Finally, I think they got so fed up with us that they managed to persuade NTT Docomo, a company that has absolutely no overlap in its business with Intage at all, to take over or bid for just over 50% of the company. Now, we were in a quandary at this point because the price was pretty attractive. It was the biggest premium we'd seen on the shares. But we didn't think it was right that the company was going to be controlled by NTT, a government company, and yet still listed, with the listing at this point being meaningless and minor shareholders not being able to access the price, or at least not necessarily being able to access it, because only 50% or 51% of the company was being bid for. So we did think about what we should do in this instance, and eventually came to the conclusion that since NTT is 33 or 4% owned by the government, we weren't going to be able to change this. So we took the opportunity of the tender offer period not to tender our shares, but to sell them into the market. So we got out completely just below the tender offer price, and the price, as we thought, has now reverted to where it was before. And anyone who's still in there, really, I don't see how that company's going to perform any longer, because it now has a large owner and it doesn't need to do anything. So that's one where the financial result was positive, but you might say that the CEO got his way in the end, and we've moved on. Another company which is going through the rounds at the moment is a company called T&K Toka. It's a large ink and resin maker. We like that company. We've liked it for a long while. We have suggested to them for a long while that they ought to go private. We felt that would... Well, we knew that there are a number of companies out there who would like to take them over. In the end, they got, I think, rather fed up with our blandishments. They took the rather extraordinary view that they would rather throw themselves at the mercy of a white knight, in this case, Bain & Company, than deal with us. And I tend to think I'm a lot less terrifying than your average Bain director, but there we are. So Bain is taking the company private. They announced 2 days ago that their tender offer has been successful, and they've got 91% of the company. So basically, what's known as the squeeze out to give them 100% will take very little time. By the middle of next month, we think the company will be completely owned by Bain, and we have been able to negotiate with Bain a situation whereby we will receive we being Nippon Active Value Fund, something called NAVF Select, which mimics what Nippon Active Value Fund does, but for US investors paying in dollars. It's an open-ended fund, also managed by Rising Sun, and also Dalton Inc. has some TK Toka shares. So collectively, we will be sold, because we will have to pay for 15% of the private company, but it will not be very expensive. The way in which private equity works, as we know, it is not much equity goes into the private entity. But this is something we've wanted to achieve since we began the fund. Although we're not private equity investors, we've always said that we wanted, if possible, to have an interest in portfolio companies that were taken private, because that would give us a second bite of the cherry when there was a second liquidity event, which could be a relisting, could be the company being sold or consolidated or whatever. We think that will happen to TK Toka. So we're very pleased that finally, this is the third time of asking, we've been able to negotiate a bit of the back end of one of these deals. And that's an example of one which is, if you like, a complete success from our point of view. Intage, partial success, and Mitsubishi Belting, company that we like and wish them well.
Yeah, some really good examples here. Thank you for that. Paul, our standard kind of final question is, I hope not the kind of trickiest one. You've mentioned a number of kind of investments, that some of which are still ongoing, but it asks kind of the speaker what their highest conviction area is at the moment. Is there kind of one particular kind of investment or just an area of the market that you're particularly high conviction in at the moment? Would there be one that you'd highlight?
Well, if I may, let me talk about Nippon Active Value Fund, because and what we're particularly focusing on. When we took over the Aberdeen and the Atlantis Trust last year, we had £19 million worth of indifferent, we thought, large and small cap stocks come to us, and we needed to come up with a liquidity management process to absorb the money that came from selling down all those stocks. So we didn't take any of the stocks in the long run. We put all the money into NAVF style companies. But what that meant was that we needed to go slightly up the size curve, if you like. We needed to invest in some mid, even largest cap companies. We bought some Toyota Industries. We bought some Seven & I. These are companies that if you like, we were thinking really it's more of an arbitrage than an investment, because we know they've got big activist investors on their register, and they are going to have to do something. So the story was consistent, but they were much larger companies that we would typically buy, and we've now sold out of both of them. So I think where the greatest conviction is to try and take the number of stocks back down again. We got up to about 36 names at one point. We're at kind of 32 now. We're in the process of selling 2 of those. I would like to think that later in the year, we will be somewhere back between 25 and 30 stocks, which is where we were before the mergers took place. And I think we will refocus again on the smaller companies, because the one thing we have learned is the bigger your percentage holding of a company, the louder your voice. So we're going to stick to our knitting and really concentrate mostly on the smaller companies and only go after mid-caps when we think we know something.
Yeah, no, that's understandable. Yeah, no, thank you for that. Paul, it's been really good to chat to you today. I really appreciate your time. Thank you for joining us.
No, great pleasure. Thank you for having me.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.